Ja, ein herzliches Willkommen. Ich begrüße Sie zu unserer heutigen Portfolio-Manager-Konferenz. Mein Name ist Florian Koch. Ich bin Senior Investment Analyst bei Scope. Das Thema Nachhaltigkeit ist sicherlich eines der Krisengewinner. Laut BVI ist das in Deutschland verwaltete Vermögen nachhaltiger Fonds im ersten Quartal um 107 Milliarden Euro auf jetzt insgesamt 254 Milliarden Euro gestiegen. Diese Zahlen berücksichtigen allerdings erstmals die im März in Kraft getretene EU-Offenlegungsverordnung, die jetzt auch Fonds mit Artikel 8 und auch Impact Fonds enthält. Offenbar haben aber viele Fondsgesellschaften die neuen EU-Vorgaben zum Anlass genommen, um bisher konventionelle Produkte auf nachhaltige Anlagestrategien umzustellen. Es gibt aber auch Fondsgesellschaften, die bereits seit mehreren Jahrzehnten auf das Thema Nachhaltigkeit setzen, und ein solches wollen wir uns heute näher anschauen. Des Weiteren geben wir Ideen, wie Anleger von Unternehmen profitieren können, die auf dem Weg zu einer nachhaltigen Weltwirtschaft profitieren. Wir schauen aber auch auf die aktuelle Situation und auch auf die Bewertungen, denn wenn die Nachfrage nach bestimmten Unternehmen steigt, steigt auch deren Preis. Wir haben daher heute einen Experten eingeladen. Unser Gast ist heute David Winborne. Er ist Fondsmanager und Managing Director bei Impax. So, hello David.
Hi, Flo.
Hey.
Thank you very much for having me this morning.
Well, it's nice to have you with us. Before we start with our topic, could you please give us some information to your position and Impax in general?
Yes, sure. So my name is David Winbourne, and I work for an asset management company called Impax Asset Management. And I think if there was one thing that really differentiates Impax, it's the fact that since our inception in 1998, all we have done is focus on investing in companies that we believe are well positioned for the transition to a more sustainable global economy. So really, that's in a DNA of the company. We manage over 30 billion sterling in assets, predominantly in equity assets. And the portfolio we're going to be talking about today is called Global Opportunities, which you can see is in the to the bottom right-hand side of those bubbles there. The reason why Global Opportunities is not classed as a thematic equity strategy is because Global Opportunities has exposure to pretty much every sector of the global economy, whereas thematic strategies often have a focus on certain sectors. So that's the Global Opportunity strategy, which I co-manage. A bit about my background: I joined Impax in September 2015 to really help form the Global Opportunity strategy. And prior to joining Impax, I was managing the in-house pension fund of Tesco Pension Investment. So Tesco, the large UK grocery retailer, decided to bring their pension fund back in-house and away from external fund managers back in 2012. And I was one of a team of 5 fund managers charged with designing the process, the platform, and philosophy behind which we would manage the equity portion of that pension fund, about 10 billion euros in assets. And prior to that, I was working as a fund manager for Bank Saracen in London also.
Okay, thank you for our first impression. So, David, before we start, let us speak about the potential future developments of the global equity markets. Well, as we all know, global economies are changing rapidly, especially the corona crisis starting in 2020 has further accelerated disruption in nearly all sectors and regions. Well, do you think that investors are still underestimating these future changes? And in case you agree, could you please give us some information or some examples that are supporting your arguments?
Sure. So I do believe the acceleration or the move towards a more sustainable global economy is accelerating. And probably the clearest example I can think of that is in the automotive industry. Now, when I joined Impax back in 2015, the transition towards the electric vehicle era was seen as maybe a late 2020 story or maybe into the 2030s, for the simple reason that essentially the technology wasn't really there. Cars couldn't go so far because of the range. The charging infrastructure wasn't built out. And what are these things worth in the second-hand market? Now, what I think is so interesting is how the transition towards the electric vehicle era has really come in by, say, 5 or maybe even 10 years to be kind of, the central pillar of most car companies' roadmaps for their future research and development. And we see that very, very clearly with companies like Volkswagen. But this example, I think, really fits into a larger pattern that we're noticing, which is really shown on page 4, which essentially details the point that we are moving from a depletive economic model to a more sustainable economic model, where economic growth can still be achieved, but with better environmental and social outcomes. Now, why do we believe that? Well, we believe it for four very simple reasons, really. Technology is enabling more sustainable business models to come through. Consumers want different things these days. You see that very clearly in the food industry with the growth of organic food. Social factors are changing, and this is companies changing their behaviors. We see this with some of the big packaged food companies that are now taking responsibility for the plastic waste which is produced as a byproduct of their products. And regulation, we're seeing very, very powerful regulatory drivers, be it in terms of the electric vehicle market, that transition towards electric cars, but across the global industry. And what I think is so interesting at the moment is lots of these sustainable transitions have been accelerated during the COVID period. We saw a very interesting quote from the CEO of one of the large technology companies, who essentially said that 2 years of digital transformation has happened in 2 months. And this was at the period of March 2020, when we all went online and started working from home. So really that acceleration of digital services has really increased on the back of COVID. And two other points I'll make to do with that as well is I think the whole COVID situation has really brought home to many of us the fragilities which exist in the global economy. I think one of the clear fragilities that we've really experienced in recent times is the fragility of complex global supply chains. I had a meeting with one of the auto components companies we invest in Global Opportunities, and he made the simple point that an automotive a vehicle contains 16,000 individual components, and you cannot make a car with 95% of those components. So there's been a real big rethinking of those complex global supply chains. And the final point on this as well is we've seen very, very big government stimulus programs, repairing infrastructure. There's very significant problems with aging infrastructure in many parts of the developed world, and a lack of infrastructure in many emerging nations. So this whole move to build back better, try to achieve economic growth, but with higher energy efficiency in the case of the buildings industry, is a really clear example there. So just three I would highlight here from the many themes we invest in Global Opportunities. One is the shift towards cloud computing, which no doubt has accelerated remarkably over the last year. I think the fact that we are doing this call from multiple locations seamlessly is an example of that. The second is digital payments, which have really accelerated during COVID. And as we move from a cash-based economy to a credit and digital, there is the potential to reduce fraud. And then very finally, and this is probably the most topical of all, is there's really been an acceleration in focus on better drug discovery. As we've seen the various pharmaceutical companies really try to find a vaccine for coronavirus, we've seen a redoubling of efforts to, improve the efficiency of drug discovery and bring them to market quicker and at a lower price point as well. So, in summary, we believe these trends were very strong before COVID, and now we believe they have really accelerated further.
Okay, on the next page, we see some losers and winners, and maybe you can give us some information on your ideas here.
Yes, sure. So maybe we'll go on to the second one here, because I've already talked about the electric vehicle transition. But I will just say, in the electric vehicle transition, we are not so interested in investing in the car companies who will be trying to navigate this transition. So they are not so much of an interest to us. But instead, we invest in the auto components companies that really make some of the electric vehicle components or the autonomous driving components, and will benefit regardless of which car company becomes, the largest in the world in 5 or 10 years' time. So really the enablers of that transition is what we invest in. And similarly, on the second line here, we can see the transition from processed food towards more natural ingredients. Now, in this space here, we do not really invest in the packaged food companies so much. Instead, we invest in some of the food ingredient companies that enable the large food groups, the household names, to reformulate their food products so they are not so heavy in salt and sugar and artificial flavors, and be more natural, but still have that same taste. So the food ingredient enablers we invest in. And finally, probably the most exciting transition at the moment is the transition towards more personalized medical care. Now, what has really enabled this transition has been the fact that the cost of mapping the human genome, in other words, getting our DNA records, has fallen from, let's say, several $100,000 15 years ago to several hundred today. And what that means is many of the large pharmaceutical companies are now trying to develop drug compounds which are absolutely right for the individual, rather than being suitable for tens of millions of different people. So in this space here, we invest in some of the companies that enable this more efficacious drug discovery, either in terms of molecule discovery or some of the biologic drug manufacturing. We are not so interested, however, in the big pharmaceutical companies, which we think face significant risks over the coming years. Not least the fact that there's, many investigations to do with drug pricing at the moment. So hopefully you get from this the sense that in all three cases, we are investing in the enablers of that change rather than really betting on the end winner.
Okay, this is very impressive. So on the next page, we see the main parameters of the fund. And from your perspective, what are the reasons why investors are investing into your fund?
I think probably the main one is that there's a general realization that you can achieve better risk-adjusted returns by aligning your portfolio with this sustainable transition. And I think also another key element of this is if we think about sustainable investment and how it's changed over the last 10 or 20 years, if we go back 10 years ago and longer, really the focus of sustainable investment was on negative screening. You can't hold tobacco, you can't hold alcohol and these kind of things. The focus of Global Opportunities really flips that round and focuses on the positive opportunities which are presented in the sustainable transition. And I think that positive screening is kind of a really attractive aspect of Global Opportunities. And I would also say probably why Global Opportunities has had some success is because it's built on very strong foundations of Impax Asset Management being a specialist in this area. The fact that this is all we have done since day one of the company, I think has also attracted many investors to Global Opportunities.
Well, okay. As we can see, the holdings range from 35 to 45 stocks. And as we can see on the right-hand side, 90% of the holdings belong to the large cap equity. So since you are investing into companies with sustainable competitive advantages, so would you say that small and medium-sized companies do not fulfill your criteria, or is it more because of valuation?
Yeah, so they certainly do fulfill the criteria. I'll maybe give a bit more color in terms of the shape of the portfolio versus the benchmark. Yes, it certainly is a large cap strategy. You can see it's at 172 billion average market cap versus the All Countries World Index at 301 billion. What we can see there, though, is it's significantly smaller than the index. And the reason for that is because we do not hold any of those mega cap internet companies in the portfolio, which I think is a really important differentiator. And we can maybe talk about that later if that's of interest. But in terms of the small cap exposure, we do have reasonable exposure to small cap holdings within the portfolio. But often they are position size limited, one, because of valuation, as you mentioned earlier on, and two, because we are looking to invest in companies that we believe have, strong track records of consistent returns over time. And many of these smaller companies, because of the stage of their company life cycle they're at, haven't necessarily developed those characteristics yet. So we certainly do have exposure to them, but they are in a risk-adjusted sizing within the portfolio. And just one other data point, which maybe listeners will find interesting, is that the median market cap of the holdings within the portfolio is about $35 billion. So if we were to look at the median, it's a much smaller number than that 172 we can see there. So there are still lots of really exciting smaller companies in the portfolio.
Okay, thank you. But as you are investing into companies to achieve long-term growth and to benefit from the transition to a more sustainable global economy, the expected turnover per year is with 20 to 40% quite high. What are your arguments here?
Yeah, sure. So the holding periods for holdings within the strategy are targeted 3 to 5 years and beyond if the shares still remain attractive over that period. But the reason why we can have a slightly higher turnover at some stage is, well, there's two reasons really. The first can be because of valuation. Even though you aim to hold a company over the long term, there's no doubt that many of these companies in our investment universe, which are very focused on this sustainable transition, we've noticed the valuations on some of these companies have just become too difficult for us to hold in the portfolio. I think probably a really good example there is a Norwegian company that does reverse vending machines. I think they've got a very big presence in Germany as well. These companies really address the issues of improving the penetration of the circular economy, reusing more plastic. But because it's such a unique company, the valuations have just become too much for us to deal with at the moment. So valuation is one reason why we have a slightly higher turnover. And the second reason would be we like to be quite opportunistic and take advantage when we see high quality companies which are unfairly sold off in certain market periods. There have been a few instances of that over the years. Probably the most recent one, which we're going through at the moment, is, if we look at the market dynamics in terms of what sectors are doing well in the market, we can see very clearly that what is in favor are cyclical companies that are geared to a global economic recovery, and cheaper companies, so companies in the energy sector, for example, or interest rate sensitive banks. When we see this dynamic take place in the markets, because we are investing in these more secular growth opportunities, we often see a relative valuation opportunity. So in the last 6 to 9 months, we've actually had a slightly higher turnover because we've seen lots of the valuations on these higher quality secular companies really become more attractive versus the market.
Well, we will speak about valuation, but since you are one of the portfolio managers, we should introduce the whole investment team. So maybe we just move to the next slide and you can just present us the investment team or your colleagues.
Yeah, sure. So just very briefly on the Global Opportunities team, you can see there's 6 members of the Global Opportunities portfolio construction team here. But it's important to bear in mind that the 6 members of the team you see here actually sit within a wider listed equity team of 37 members that sit across the US, Hong Kong, and of course in the UK. So it's a very wide range of expertise we can draw on. And I should also say as well that amongst those 37 members of the team, we have very, very deep sector expertise and experience. So, for example, one of the other strategies we run, as well as Global Opportunities, is a food strategy, really trying to invest in companies that address the problems of food waste we have globally. Now, the fund managers who manage that fund have a huge amount of experience at investing in some of those consumer staples companies, which are relevant for Global Opportunities as well. So we can really, draw on that deep expertise. You can see here, I co-manage the strategy with my colleague, Kirstine Morrison. Kirstine has been with Impax for about 10 years now. And what I think she particularly brings to Global Opportunities is she has also worked as a buy-side financial sector analyst. And the financial sector, particularly companies involved in financial inclusion in emerging markets, are a significant part of Global Opportunities' focus. So she really brings that expertise. And one final member of the team I'll highlight here as well is Bruce Jenkins-Jones. Now, Bruce was the co-founder of Impax back in 1998. He co-founded Impax along with Ian Sim, who is still our CEO. So Bruce brings a huge amount of expertise and experience of investing in this sustainable transition, over a more than 2-decade period. So we think we have a nice range of skills and expertise within the team, and they fit in within that wider listed equity team as well.
Okay. Well, one of the crucial
then maybe moving on to
yes, one of the
sorry,
crucial
Florian, please.
No, it's no problem. I just want to move to the investment process. So one of the crucial things is the strategy of the fund. So in this one here is a sustainability lens. Maybe you can give us some information to your investment process and give us more information to ESG, impact investing, and sustainability of the fund.
Yes, sure. So one of the key bits of thinking we had to do before launching Global Opportunities was how we screen this vast investment universe for companies that are potentially aligned with this sustainable transition. And the output of that was really our proprietary tool called the Sustainability Lens. Now, how the Sustainability Lens works is it looks at the subsector level within the market to try to find which subsectors have greater exposure to some of the exciting opportunities we're interested in and less to the risks, and avoid areas which have higher exposure to risks and less to opportunity. And just to explain what I mean by subsectors, if you think how the sectors are organized in global markets, we have consumer staples, consumer discretionary, industrials, healthcare, and so on. They branch out to 158 subsectors. This is GICS level 4, which is the most detailed level of subsector classification there is. And what we have done is we've looked through each of those 158 subsectors to try to understand the balance of opportunities and risks in each of those subsectors. Now, if we could go to slide 9, please, Florian. I'll explain what the opportunities and risks are. You can see we have 8 opportunities and 9 risks. And all I will say on this slide here is that, not surprisingly, some of those subsectors have much greater exposure to those risks and less to opportunities, whereas others have much higher exposure to opportunities and less to risks. So, for example, if we look at the risks on the right-hand side, we can see antitrust regulation. Now, antitrust regulation can be a particular issue for the software industry. And the reason for that is because if you are a successful software company, you kind of become a natural monopoly in your space. If we think of, Google in internet search, for example, there are many examples of those kind of market dominances. Conversely, other subsectors have much greater exposure to many opportunities. So, for example, access to finance is a really interesting area for us. And 3 subsectors we are particularly interested in under access to finance would be emerging market insurance companies that essentially provide a social security net for individuals.
Da scheint gerade ein technisches Problem vorzuliegen. Wir warten noch eine kurze Sekunde. Vielleicht können wir David gleich wieder erreichen. Wir versuchen, David wieder zurück ins Webinar zu holen. Wir werden vielleicht noch 1, 2 Minuten brauchen. Ich bitte gerade noch um Ihre Geduld, bitte.
Hi, Florian.
Hey, David.
Hi.
Maybe we should just stop your camera because of the
Yes,
internet connection,
let's
and
go
just
for that.
have your audio voice. And we are still on page 9, and please go on with the investment process.
Fantastic. Did I talk about some of the risks? I don't know how much of that you caught, Florian,
You
or...
you were starting, but maybe you just repeat 1 or 2
Oh, okay,
sentences.
yes, sure. So what I was saying there was that there are certain subsectors which have much greater exposure to these risks. So, for example, antitrust regulation can particularly impact, say, the software sector, because if you are a successful software company, you kind of become a natural monopoly in your area. We see that with internet search and other software packages. And on the other side of the equation, on opportunities, we see really interesting opportunities in certain subsectors, such as access to finance, which we can see in the top left-hand side. Now, access to finance is a really interesting area for us. And 3 of the subsectors which are particularly exposed would be emerging market banks that provide access to the formal financial system in countries like India, emerging market insurance companies that provide, really that social security net for many individuals in emerging nations where there is no state provision for them. And finally, it would also include some of the payment processor companies that enable that transition from a cash to a credit and digital-based economy that I mentioned earlier. That has a huge potential to reduce fraud, particularly in emerging nations. So that's an example about how 3 of these subsectors are particularly interesting for us. And if we move on to the next slide, please, Florian. you can see an example of 4 of these 158 subsectors. And what we can see here is that a subsector, such as life sciences and tools, has much higher exposure to the opportunities we're interested in, because these companies make some of the imaging equipment which goes into hospitals, or some of the drug discovery equipment which goes into labs to enable better drug discovery, and less exposure to those risks. Conversely, a subsector such as diversified metals and mining has a huge amount of exposure to risks, things like pollution and waste externalities, labor constraints, but less to the opportunities. In that way, we really make that hierarchy of focusing on those high opportunity and low risk subsectors.
Okay, David, thank you. On the next page, we find your ESG research. Maybe you can give us short information to this slide here.
Yeah, sure. So in terms of the ESG work we do at Impax, it is again proprietary ESG analysis. And again, I think that's an important differentiator of Impax, that throughout our history, we've always done our own ESG work on our companies. And why I think this is so important is because our own internal ESG work often highlights potential ESG risk issues that the off-the-shelf providers of ESG data do not necessarily provide. And I think that really helps us provide some, additional insight into the companies that we invest in. And a second key element here as well would be the engagement that we do with our companies. So we engage with our companies that we invest in very, very closely on ESG matters. I think one of the things that really helps there is the fact that we've invested in many of the companies in the sustainable investment space for 10, 15 years and sometimes longer across the impact strategies. So we have developed very deep relationships with many of our investee companies, and that means we can get very good access to discuss ESG issues with them. And I think just the one final point I'll make on this slide as well is the fact that we have the ESG integrated into the investment process really helps for us distinguish between sustainability and ESG. And why I think this is an important differentiation is because for us, sustainability is what a company does, what its business activities are. ESG is how it goes about its business. And what I mean there is you can sometimes have a contradiction between the two. So, for example, there is the very large electric vehicle company, the specialist company in the world whose name I cannot mention, who obviously from a sustainability perspective has very, very strong sustainability alignment because they are moving the conversation in the automotive industry towards electric cars. But at the same time, we have significant concerns about the ESG processes and profile of that company from primarily a governance perspective, related party transactions, board remuneration, and things like that. So that's a really important point, I think, the differentiation between sustainability on the one hand and ESG. And we try to have our investments aligned with companies that are sustainability focused and with strong ESG processes and profiles.
Okay, so did I get you right that you don't use external providers and just internal scorings and calculations?
Yes, we have access to the external providers, so we subscribe to all the databases, but the ESG work we do on our companies is all proprietary, based on our own analysis.
Okay, thank you. Well, on the next page, we find the current portfolio. And well, as we are speaking about a global equity fund, 50% of the assets are invested in North America, which is less than the 61% of the MSCI or Country World Index, but it's still a large part of the portfolio. So what are your reasons here?
Well, the simple reason is that many of the best companies in the world reside in America. So if we look at the various industries that we invest in, say from semiconductor chip design, cloud computing, payment processing, autonomous driving, many of the very, very good companies in the world are American based. But nevertheless, we are still 11% underweight North America. So as you say, we are 50% North America versus 61 in the index. And what you'll notice, the flip side of that is we are overweight Europe for really for two reasons. The first is that we find very, very interesting healthcare and financial inclusion opportunities in Europe, particularly in Germany. In fact, we find some really interesting companies really at the cutting edge of enabling better drug discovery. So we have significant exposure to a couple of German companies involved in that space. And on the financial side, we have exposure to some UK reinsurance companies that enable the insurance of very difficult to insure risks, such as cyber attacks, for example, or natural catastrophes. And the second reason why we are overweight Europe is because of valuation. I think we've had a huge number of geopolitical uncertainties in Europe at the moment, not least with Brexit. And I think what we notice as a result of that is that the valuations on many similar European companies versus US companies are more attractive. And so we find some really interesting opportunities in the European equity space.
Well, you have already mentioned the valuation, and especially in the US, it's a very interesting topic. So, based on the profits in 2020, US equities are trading on a PE multiple of 32, which is near a record high. So, even if we calculate the PE ratio on the current profits of the S&P 500, the number is still 23. So, the historical average is between 17 and 18. Would you say equities in the US could become less attractive in the next months?
Well, I would say obviously we are going through a very strange year in terms of earnings at the moment. I think we won't see a normalization in earnings until next year at the earliest or the year after. And so that means looking at current valuations can be a bit of a challenge at the best of times. But I would also say, to your point, I think we have to say versus other markets, the US stock market does look expensive. And that's why we are overweight Europe at the moment. And I think there's probably two reasons for that. Firstly, I think they have a very clear stimulus spending package coming through, which means that many of the industrial companies are benefiting from that. But crucially, and this is something we are very, very mindful of, is we have seen a really fast rise in retail fund flows in the US. I was reading the other day that something like 31% of trading volumes on the S&P 500 index are retail traders, trading many of those internet companies that we are familiar with. So there's no doubt that the US does look, relatively expensive, notwithstanding we are in an unusual year. But I would say also as well, earnings are a very volatile metric because of, particularly in these periods of significant change. So we prefer to look at free cash flow yield. The old saying is that earnings can be an opinion, whereas cash is fact, because it doesn't have so many accounting adjustments in it. And what we notice when we look at the free cash flow yield on many of the global indices is that because there's been a very, very significant expansion in free cash flow generation over the recent years, it's kind of nearly compensated for the share price rises in many cases. So the free cash flow yield actually is, it's not really out of line from many historical perspectives because free cash flow generation has improved at the same time. But to summarize, the US market, there are some really interesting individual companies in there. But as I said, the European market is where we're looking for, some of these really exciting sustainable companies at the moment.
Okay, thank you. Well, we should definitely speak about the performance of the fund, which we can find on the next slide. So as we can see, 2020 was a great year for the fund, but year to date, the performance of the fund is positive, but with an underperformance in comparison to the MSCI. So what are the reasons, and do you expect that this could change during the year as the summer months could become more volatile?
Yes, it's a very, very tricky one. It's I would say just if we look at the Global Opportunities strategy performance since inception, the fund was seeded in January 2015. We are very, very pleased with the performance of the strategy over those 6.5 years. And I think one thing we've been particularly pleased with over time has been the fact that the fund has outperformed in both good years and bad years for global markets. So if we were to look back at 2017, 2018, 2019, we can see that the fund has outperformed, in bad years and good years for ACWI. So far this year, the fund is underperforming by about 2% on the current data. And the simple reason for that, as I alluded to earlier on, is the fact that cyclical and value companies are very, very much in favor in terms of market leadership. And it's very interesting that if we look at what has led market performance since March 2020, when the COVID impact hit markets, is in the first 2 months. So in March and April 2020, we saw a very, very strong outperformance for global opportunities. And the reason for that is because the companies we invest in tend to have higher returns than the market and lower levels of debt. And in times of uncertainty, people are very much attracted to companies with lower levels of debt. But we've noticed since then that there's been a remarkable rally in cyclical companies in global markets. And we were very pleased in 2020, despite the fact that there was a big rally in some of those cyclical sectors, the fund still outperformed quite nicely during that year. In 2021, so far, we've seen a continuation of that dynamic. So we have seen the cyclical and value companies really continuing to do quite well. But we were very, very pleased to see that over the last month or so, the global opportunity strategy has started to outperform the market again. And I think because people are concerned that the rally in some of these lower quality companies has kind of gone too far, essentially. Many of them have doubled since the March 2020 lows. And I think over the next few months, perhaps as inflation concerns start to abate, then we will start to see some of our companies which are naturally higher quality and more secular growth rather than cyclical growth targeted really start to outperform again.
Okay, thank you. We got one question in the chat. So what is the usual performance or the usual return an investor could expect from the fund over the next years?
So the targeted outperformance of the fund is 250 basis points gross of fees. And over the 6 years of the strategy, we have delivered that performance, which we are very pleased to see. We should also note that we run the fund within our tracking error bounds of 3 to 6%. And what that means is that we have less volatility to achieve our returns, essentially. And so the fact that we run within our tracking error, which means the difference from the ACWI index, means that kind of we can achieve that with lower levels of volatility. So we hope we can continue to develop and to deliver the outperformance we already have over the 6.5 years of the strategy so far.
Thank you very much. So I think we will just stop here at perfect timing. So thanks again to David from Impax Asset Management for his brilliant insights. Vielen Dank auch Ihnen für Ihre heutige Teilnahme. Wir würden uns natürlich freuen, wenn Sie auch das nächste Mal wieder dabei sind. Sagen Tschüss aus Frankfurt und wünsche Ihnen einen angenehmen Tag.
Thank you, Florian. Bye-bye.